Hey guys! In this video we're going to look at T accounts in a little bit more detail and how we can derive some of that information when we know specific values. And so if you haven't looked at the T account basics video, I might pop over there and watch that first, but if you're comfortable with T accounts, we will go ahead and just go get started. So let's go ahead and look at an asset T account first. Whenever you're looking at a T account, you'll always have a beginning balance. You'll also have things that make that T account bigger, things that make it smaller, and then you have an ending balance. And when we look at either a liability or an owner's equity T account, the same can be said for that, right? We have a beginning balance, we have things that make that T account bigger, things that make that T account smaller, and then we'll have an ending balance. Now essentially what we can do is we can say, okay, for the asset we have A, the beginning balance, B, things that make it bigger, C, things that make it smaller, and D is the ending balance. And we can write this as an equation, A plus B minus C equals D. And I'll go ahead and just do this on the liabilities and owner's equity T account that we already made. And so we basically have that same equation, A plus B minus C equals D. And what's really valuable is that if you know 3 of the 4 pieces of information, you can solve for that missing piece, right? And that's what makes T accounts really valuable. So let's go ahead and take this and actually put it into context. And let's say we're looking at an unearned revenue account example. So unearned revenue is going to be a liability, and it's created when we receive cash from customers for service or goods that we haven't actually provided yet. And again, when we're looking at this T account, we have a beginning balance, we have things that make it bigger, things that make this account smaller, and then we have an ending balance. So let's say in this example that our unearned revenue account we know has a beginning balance of, let's say 50. And that the ending balance is going to equal 10, and that we have some additional information that the cash we received for those goods, let's say in this example goods that we've not yet provided, let's say that was equal to 30. So we can essentially use this information to fill in our unearned revenue T account, where that beginning balance is 50, and that end balance is 10, and then we ask ourselves, what's this 30, right? Is this cash we received going to make it bigger, or is it going to make it smaller? And when we're looking at unearned revenue, it will make it bigger, right? Because they're paying it in for goods that they've not yet provided, so that will increase our unearned revenue account. So now looking at this T account, we have 3 pieces of information, and we're able to use that information to derive more than we actually know at this point. So what is making this T account balance? Okay, what we have to do is we have to say, we know that A plus B minus C equals D, so 50 plus 30 minus what equals that 10 ending balance. And we'll solve that C will equal 70. But that kind of begs the question of, okay, well, what does the 70 actually represent, right? And I think a good approach of this is just to think, well, when does my unearned revenue actually get debited? When does it decrease? And it decreases when we actually provide that good or service to the customer and we're able to recognize that revenue. So if you think about the journal entry, you'll have your debit to unearned revenue, and then you'll have your subsequent credit to your sales revenue for that same $70 amount. And I think what's really valuable here is we've just shown how you can have 3 pieces of information that might not be seemingly related to revenue, but when you actually plug them into a T account and solve for your missing piece of information, you can solve for what's missing. You can solve for the sales revenue related to this unearned revenue account, and that can be really valuable in accounting. However, I think it's really important to note that the information didn't come from just saying that, oh, our unearned revenue account decreased by 70. Really, the valuable piece of information came from, okay, if my unearned revenue account decreased by 70, then asking yourself the next question of, well, what does that mean? Once you ask yourself that question and you can jump from, well, this is the account that decreased, and subsequently I know if this decreased, that means that this account had to have increased, or this other account would have also had to have decreased. Once you can get to that kind of second step, that's where you're getting the information from, and that's really where the value comes from. So I hope you keep this in mind when you're looking at T accounts, and I hope this video was helpful.